All right, welcome. I've got my partner and Chief Investment Officer, Brad Tremitiere, with us today. Hey, Brad.
Hello, Greg.
And Brad and I are going to be talking about the recent run-up in the stock market. S&P up almost 9% year to date, despite everybody worried about tariffs and interest rates and whatever Trump's going to do. I mean, the market's been pretty resilient, but there's also a story I don't think a lot of people are talking about, and that is the job numbers.
Yes, Greg, the job numbers have been, let's just call them strange for the last, 3 years. We mentioned before in a number of our writings how the government job data from the middle of 2022 to the end of last year was really, I can't even put into words, excessive versus what the historical average is. I mean, for, the 12, 13 years previous to 2022, I mean, the government added like 4,500 jobs on average per month. But from the middle of 2022 to the end of 24, they added close to 45,000 jobs per month. So there was some abnormalities in what we saw as far as government jobs go, which kind of tended to make unemployment look better than what it was. But now recently we've started to see some much larger revisions as I guess we could say that the way that the Bureau of Labor Statistics has done their polling and their surveys each month have brought in a lot of questions. So, since COVID, we've basically have seen the number of monthly surveys return drop by 25%. So there is a significant amount of divergence between the initial numbers provided and then what the real numbers come in when all the surveys are put into process.
So isn't there like a statistic that like a third of the jobs that they thought were created were not there? I mean, that's like a pretty big divergence. It's like,
correct.
Where are they getting these numbers from? And then all of a sudden it's like, whoops, we were wrong.
Yeah, it just has to do with the way they do their surveys, the way they have their algorithms set up to assume certain data. And again, the I don't remember the lady's name that got fired a couple weeks ago. She had been in place since the beginning of 2024. And even through 2024, there's an excessive number of revisions. Not as large as we've seen them lately, but it has to do with the way they calculate the data. And that's really where the problem lies, because if if the economy is in real time with the Fed and the Fed is resilient upon these numbers to be correct, when we get massive revisions like we've seen, it just, you sit there and you say, okay, well, if job numbers are this weak and, the underlying strength we've seen in the labor market the last number of years is starting to chip away, but the Fed is saying that everything's good based on their dual mandates because of what the current data is, it's a little concerning.
Yeah, something's got to give there, which makes a case for a rate cut. I mean, you've been calling for the Fed to cut rates, and I know that I can hear you cursing in your office when it doesn't happen. And I know there's an upcoming meeting coming up, Jackson Hole. So do you think they're going to start cutting rates?
Well, they should have cut rates last month. When they met in July, they should have cut rates by an emergency 50 basis points. So we've shown before how the Fed should maintain their policy rate in line with where the 2-year yield is. So when the 2-year yield started to rise in 2021, it took the Fed, 10 months before they started to raise rates. They were much too late. Now we've been underneath that 2-year for 28 months since March of 23. And although the Fed has cut, we're still a significant away from where the 2-year yield is. So it says that the Fed is being way too constrictive with inside the operations of our economy. So we've started to see, we saw 2 dissents last month, which were the first 2 dissents on a Fed meeting that we've seen, in 30 years. Now we've got Jackson Hole coming up, which is always a interesting meeting because the Fed chair is the keynote speaker, and Powell has had, a couple speeches where he has, I don't say he's laid an egg, but he's been very forceful in how much stronger the Fed is going to be moving forward with higher rates. And it's caused some issues. I think you're going to hear something totally different here the last Friday of the month because I think they're all starting to believe that based on what they're seeing with job numbers, that interest rates have got to start coming down. If not, we're going to run into a problem where unemployment starts to rise too fast.
The Fed's case was they were worried about inflation. Everybody was saying, oh, the tariffs are going to cause all this inflation. Everybody was a tariff expert, including my daughter. You don't know anything about tariffs. I still love you, honey. And that just doesn't seem to be the case, right? I mean, actually, it's kind of working, right?
It still remains to be seen. I mean, the payoff that we've gotten so far from tariffs, which should be about $30 billion for the month of July, has been incredible, especially because there's been no inflation. But inflation is a funny thing because we couldn't find it for years. I mean, all the years of quantitative easing, we never found it. Then suddenly it pops up in 2021. And this is where most people are, frustrated with Jerome Powell, because in the summer of 21, he kept saying, oh, it's transitory. Everybody remembers transitory. It's not going to last very long. It's not that big of an issue. Yet we were seeing inflation on a year-over-year basis jump 7-8%. Mm-hmm. Now we're a little bit above 2, and we've had all these tariffs in place. So it's not as big of an issue anymore as it once was. There's still concern out there, and rightly so, because of what we went through a couple years ago. But it's not the same environment at this point.
Well, and nobody's getting free checks in the mail and business stimulus money and $5 trillion of new money that goes in the system. Obviously, you're going to have inflation with that, and so hopefully that it has changed.
And we haven't seen oil go nuts. I mean, you've got to have oil go up to be able to get inflation. It's oil and war. Now we're still involved in some different conflicts across the globe, but we've not. The price of oil has done nothing compared to what it did in 2021 and 2022. So without that pressure upon natural resources, it's not, inflation has a hard time showing up.
And you just have like two forces opposite. One is obviously the technology, AI, everybody is so excited about, rightfully so. And robo-taxis, I mean, technology is just exponentially growing. And so nobody wants to miss out on that. But they're also, there seems like we're right on the line of like, if the job market keeps getting worse and people become unemployed, you have the real estate market that's been falling, people are selling houses. It seems like it's the right time for the Fed to cut. But the market's been strong, and you also measure the market strength through, you look at the market breadth. You want to talk about what breadth is and how you use it for more of a short-term view?
Yeah. Well, breadth is basically the number of advancing issues on an exchange minus the declining issues to give you a net number of advancing or declining stocks each day. Then you add it to the previous day's number. It basically is a gauge that shows you overall strength from buying or overall weakness from selling. So we really are looking for a divergence where mainly the New York Stock Exchange breadth, which covers a number of different issues, just not equities. You usually start to see a divergence where breadth gets continually weaker, meaning there's more selling underneath the market, yet the market is able to maintain its value and in most cases go higher. So we saw a little bit of that to begin the year. That was obviously corrected in April when the market dropped. But since then, breadth has been a big leader. There's been a lot more buying than the actual performance of the underlying market. So that's, breadth has pulled the market higher.
Typically, August is not a great time to be an investor. People say sell in May, but you say typically you sold in August and bought back in October. You're not that we would recommend that ever, but it's usually a bad time for the markets, but it's still been holding up, and maybe breadth.
Well, breadth has helped, whether it's the New York Stock Exchange, whether it's S&P, whether it's the high yield bond market. I mean, the bond market for interest rates still fluctuating a lot has remained relatively tame. We say sell in August because frankly, July has been the second best performing month for the market in the last since the millennium for the last 25 years. So you don't want to miss out on July. And once again, July was positive this year. But it also shows that when the market is strong in the months of July, June, and May leading into, April and September, stronger months usually mean that the market ends up being stronger. We can't guarantee that's going to be the case this year. Returns will still be muted, but they're typically positive. That obviously may not work out this year, But with strong breath, with the relative performance of the market moving in to August and September, things usually work out pretty well.
And we kind of have a neutral stance. Like we're like cautiously optimistic, although there's obviously the jobs numbers and employment is going to be a big thing. And now if the Fed does start cutting rates and say the real estate starts to bottom again and gets more affordable, I think that would be a good tailwind for the economy and the market.
And I think you can see it already because I think home building stocks obviously usually forecast what mortgage rates are going to do. And we've actually started to see home builders who've had a rough year and a half or so start to turn around here a little bit and work their way higher. Not saying their underlying, fundamentals are as strong as they once were, but we're starting to see some of that relief on assumed rate cuts, which would lead to lower mortgage rates, start to show up in some of the, the home builders as well as some of the other construction type companies. So it's going to be interesting going forward. We can't say that things aren't going to, flatten out or go weak for a while because strange things happen in August and September. But it's a bridge to get to the end of the year because usually October, November, December, especially in the first year presidential cycle, are interesting and mostly to the positive side. Then we get into next year, which is going to be really interesting to see what happens because the second year is always the weakest, like 2022, the weakest part of the presidential cycle. But President Trump has done so much of what he said he was going to do already that it's going to be interesting because usually the second year is the worst because of policy action. The honeymoon's over, you're getting to work. Now with the way Trump has taken, attacked tariffs, trade deals, a number of different things early in his first year, it's going to be interesting to see what happens next year.
Yeah, I mean, the market is certainly not cheap. It's pretty expensive by any historical measure, but still not a whole lot of reason to be bearish at this point. But certainly we'll be watching how the employment goes. We'll be watching what the Fed does. We always say so much on the market returns are dependent on the Fed, what the Fed's doing, whether they're neutral or tightening or easing. And
one thing that's interesting is for all the moving parts, we've actually seen company fundamentals and earnings and revenues come in better than expected overall. Plus, a number of companies have provided upgrades to their outlooks. Whereas, 6 months, I can't say 6 months ago, but in February and March, when the tariff issue started to become a concern, it was a much larger concern for our multinational companies because how are they going to be able to perform as they have if they're wrapped up in trade fights, trade battles, trade wars, whatever you want to call them. So a lot of that has passed by. So it's very promising that our fundamentals have not started to deteriorate away yet.
Yeah, earnings have been good. So
yeah.
So for now, we just continue to ride the market. If anything changes, if the interest rates, we'll be following what happens at Jackson Hole, and then certainly following the employment figures. If any of that changes, we will keep you informed. So stay disciplined, stay invested, and we will see you in September. Thank you so much, and God bless.